there's a silent killer out there, and that's called inflation. What it means is today you buy a Coca-Cola for $1, and in 10 years' time, that Coke costs you $2. So if you put your $1,000 under the mattress today, in 10 years, you take out that $1,000, it's still $1,000, but its purchasing power has halved in the example I gave with the Coke. So instead of being able to buy 1,000 Cokes, you can only buy 500 Cokes.
Welcome to the Nautic Nomad podcast. I'm your host, Randy Berry. Throw off the bow lines, sit back and relax as we discover adventure, explore the world on water, and share about everything yachting. Today I'm speaking with James Skuse from Southern Cross Wealth. Southern Cross Wealth is a group of licensed professionals that are helping Yacht Crew with offshore banking and investments. So they are not licensed to help American crew. So if you are American listening to this podcast, you have to find a licensed professional in the United States. However, there's still a lot of great information if you have questions about investing that we break down in this podcast. So it's good for everyone. I know that it can be really overwhelming for people if they haven't even thought about investing or why they should even invest their money. Something that we talk about is the silent killer called inflation, and why putting your money underneath your mattress or in your savings account is not the best thing for you. So make sure to stick around and take a listen. If you have any questions, we break it down nice and easy. Also, we just want to say a big shout out to everyone who has left us a review in the App Store. Thank you so much from the bottom of my heart. I want to wish you guys all a very Merry Christmas. And as we're looking forward to 2019, I hope that everyone's got a lot of value out of these podcasts. Just thinking about planning ahead for the year ahead. I know that everyone's probably spent a lot of money on gifts or traveling to see their family, but let's really come together and come up with some awesome solid goals for 2019. If you want a nice and easy planner, if you head on over to the Crew Coach, Koreans put together a planner for 2019. You can just fill out really easily for your goals. So yeah, if you guys have been loving this podcast and liking this series, please subscribe and give us a rating. It just helps us with the algorithms to reach more people. And thank you so much. Thank you so much to my guest today, Southern Cross Wealth. And without further ado, let's dive on in. Could you tell us a bit about your team, yourself, and a brief introduction of what you guys do?
My background is I studied finance, did my honors in finance, and then moved to London, where I worked for a Japanese and then American investment bank on their fund accounting side. I then came back to South Africa and trained financial advisors on investments, and thereafter I joined Southern Cross. With Southern Cross, for the last 10 years, I've been advising high net worth individuals on their wealth management, which is how to invest their money and protect their assets and plan their estate. The other members of the team, which I guess our clients would have contact with, would be Mia Steenkamp, who also has her honors in finance, and she's like the unicorn to us because she worked as a stewardess on the yachts for several years, and then she moved into financial services for the last few years. So she's actually got both sides of the yachty financial services coin. And she's now our COO and wealth manager. So the investors out there will generally be dealing with her in processing the investments and setting up a record of advice and investment policy statements. And the other members of the team that are worth mentioning is Captain David Smith, and he is essentially the spark behind Southern Cross Wealth targeting yachting professionals, and that occurred by myself helping Dave with some of his investments and having a look at what the competition had to offer, and just very quickly realizing that competition out there was being quite predatory and not providing the best advice out there, nor the best cost structures, and actually making things quite opaque and locking investors in for long periods and not really doing what would be appropriate for yachting professionals and their hard-earned cash. So, yeah, Dave is by his name captain, and then the other people that'd be worth mentioning would be John Austin, who's on our investment committee, and John has I think nearly 4 decades in the financial services industry, and he previously headed up a listed brokerage, a specialist division, and then he founded the Southern Cross group of companies. We also have, we're lucky to have a fellow by the name of Dave Steer, who is a qualified actuary. He also sits on our investment committee. He has previously headed up one of the largest actuarial financial service providers in Africa, Momentum Consultants, and he lends his technical expertise to the team. I don't know if I mentioned on my side, while I've been working, I did complete my CIMA, which is a Chartered Institute of Management Accounting, and then also my CFA, which is your Chartered Financial Analyst.
Okay.
A bit about Southern Cross. The Southern Cross group of companies are licensed financial service providers in South Africa and in Mauritius, and launching our yachting platform through the BVI.
Nice.
The team together has over 100 years of experience in financial services.
That's amazing. And for anyone who might not know what an actuary is, can you elaborate on that a little bit more?
What an actuary is?
Yeah.
So an actuary is basically like a propeller head with numbers. You know, they'll build a spreadsheet and send a monkey to space with that spreadsheet. They are predominantly employed by pension funds, insurance companies, and any financial service companies which require serious number crunching, a lot to do with probabilities.
Okay, like risk assessments and all that kind of stuff.
Yeah.
Awesome. So you've been doing this for how many years yourself?
I've been in financial services now for 11 years.
Wow. And you tried your hand at yachting for a brief moment, right? Dave said when we were
Yeah, I did one day. I walked the docks and got some day work in on Antibes, and spent the whole day scrubbing the deck with 2-part cleaner, which like dissolved my fragile elbows and knees. And then I took my 100 euros and promptly spent it. I think it was in the absinthe bar, and got lost in the maze of streets in Antibes.
Sounds like a pretty standard night on Tubes.
Yeah. Yeah.
That's awesome. So that's great. So you've kind of seen what people do, if they're out there scrub and teak, or at least you've seen it for a day, and you guys have a nice balance there of professionals in both industries, in the yachting and then
Yes.
also in the wealth management. So for anyone who's listening, why would you say that they should invest in stocks, bonds, etc., rather than say just keeping the money in a savings account,
Yeah.
or maybe just only like investing in a property?
Yeah. Yeah, that's a great question, Randy. And the first part of that answer is people need to understand that there's a silent killer out there, and that's called inflation. And that's, we experience that in some countries more than others, or it's easier to see in some countries more than others where you have a high inflation rate. But basically, what it means is, today you buy a Coca-Cola for $1, and in 10 years' time, that Coke costs you $2. So if you put your money under the mattress, you put your $1,000 under the mattress today. In 10 years, you take out that $1,000. It's still $1,000, but its purchasing power has halved in the example I gave with the Coke. So instead of being able to buy 1,000 Cokes, you can only buy 500 Cokes. So what stocks and bonds, and more so stocks and listed property, provide is the highest probability of beating inflation in the long run. So by having exposure to these asset classes, you actually hurdle over that inflation rate, and your money can grow in what we call real terms, i.e., it's growing faster than inflation. And that's how you create real wealth. And we have what's also called the compound interest curve, which means you essentially getting interest on interest. So if you're growing your money faster than inflation in real terms, then you're actually going to have a compounding effect on your underlying wealth and the growth that you actually have on top of that, and it creates like an upward sloping curve, that it's exponential, that
Right.
that curve. So your second part of the question was, and why not property? Property is a great asset class, and a lot of people are very familiar with it, and it's there's nothing wrong with having some exposure to it. But I think what people need to bear in mind is there are some limitations, and maybe there's pros and there's cons. So I'll start with the pros, and that is property's great, in terms of you can touch it and it's tangible, and I think that's why a lot of people like it, because it's something that they're familiar with. They've lived in properties, they've potentially seen their parents managing it, and it's something they can see the bricks and mortar, and it's quite a intuitive kind of thing. You get a tenant, and the tenant gives you an income. So that's the one pro. Another pro would be you can leverage that property, which means you can borrow money from a bank usually in order to invest in that property, and provided you manage it correctly, and the property market doesn't tank, or you don't have tenant vacancies, then you've leveraged, and by leverage I mean magnified the return, because you've used the bank's money to to invest and grow that wealth. So those to me are the two big pluses of property. It's a tangible asset that's easy to understand, and you can use finance. You can use the bank's finance to actually invest in the asset class, partially invest in it. So the cons would be a number of issues, would tie back to why would you want to have stocks and bonds, and we need to qualify that further by saying a diversified portfolio of stocks, listed property, and bonds, and maybe a little bit of cash, because a single unit or a single home or commercial property is concentrated in a number of respects, i.e., you putting your eggs in one basket would be the colloquial term. You have the property sitting in one geographical location, so there is a geographical risk to that. If, to use an extreme example, a meteorite hit it, that is a risk. Yes, you can insure against certain things, and that's something more that you need to consider. But it also is then at the vagaries of the property market in that area. So should you have a downturn, or should the area become undesirable, then that could seriously impact your investment. And generally these property investments are a large portion of a investor or a yachty investor's wealth. So another example, which may have been extreme a while ago, but maybe now isn't that extreme, is, let's say you buy a property in Fort Lauderdale or in Miami, and we continue to see the increase in global warming that we have, and sea levels rise, then property in that area will be severely negatively impacted. Then you're also concentrating your wealth in that single asset class. And by asset class, I mean stocks are an asset class, bonds are an asset class, cash is an asset class, property is also an asset class. So you once again, it's the whole adage of not putting all your eggs in one basket. You are concentrating your risk in this one asset class.
Right.
So I don't know if does that answer the question.
Yeah, definitely. Just mitigating your risk with diversifying your portfolio is a
Correct.
clever thing to do.
Yeah.
That makes a lot of sense. And now you guys have different levels that you work with people to invest, right? So what are some examples of those holdings in each of these categories?
Okay. So yes, I wouldn't say it's different levels because that implies that there's some investors that are higher or better or lower than others, but they are.
Right.
What we've done is we have set up different funds which we put our investors into, and those funds have different risk levels or different exposures and higher or lower risk. So to break down what those funds are is you start with our cautious fund, which we call the anchor, and that would have a lower allocation to your higher risk, higher growth assets such as stocks and listed property. Then we have another fund which you can imagine is moving up your risk spectrum. And when I say you move up your risk spectrum, you also move up your potential return spectrum. And also, as you're moving up along the spectrum, you need to have a time horizon, like have a minimum investment period, and to achieve what the portfolio sets out to achieve. And the next fund would be the cruise, which would be what would colloquially be known as a moderate fund, and that has a slightly higher exposure to equities and listed property, but quite balanced across the asset classes of equities, listed property, bonds, and cash. We then move to the most aggressive of our core funds, and that is called the Voyage. And the Voyage is what would be termed a moderate aggressive fund. So it has up to 75% can be in equities or stocks, and that means it has a higher risk profile, which means you need to hold it for longer, but it also has the chance of giving you a higher return than the other two funds in the range. So how we generally dictate which funds to put an investor into, and often investor will be in one or two or three depending on their needs and requirements in the future. But to keep it simple, if an investor has a 2-year time horizon, for example, they may want to access the money within 2 years, then they would go into the anchor. If it was if they need to be 3 to 4 years, they could park their money and let it grow. Then you would go into the cruise, and for 5 years or longer, then you would go into the Voyage. And the reason for that is as you have higher allocations to the growth assets such as stocks and listed property, there's more volatility. We all familiar with the stock market going up and down, and in short periods it is volatile and it jumps up and down. But as you stretch that period out and you have a longer time horizon, then it kind of smooths out. You can imagine the fluctuations as a noise, and over a longer time period, then it starts to become more probable that it will achieve the returns that stocks have previously given us. Then we have a fourth fund, which is quite a sexy fund, called the Tech Evolution Fund, and that is a pure equity fund which invests in index tracking funds which have exposure to the companies that are involved in the technologies that are part of what we call the fourth industrial revolution. So that's any technology that could change the world, as we know it, and that is busy changing the world as we know it. Examples of that would be 3D printing, biotechnology, nanotechnology, other exponential technologies, social technologies. So it's quite exciting. But if you look at that on the risk return profile, you can imagine that being much higher risk than the other funds. So there we say to investors, you need to have like a 7-year time horizon. You need to be comfortable with leaving the money in that investment for 7 years to give it the chance, if you did have a big correction like you had, say, in the dot-com bubble,
Right.
where your stocks could have gone less than half, and certain individual stocks actually got completely wiped out. But if you had the time and you stayed in, if you look at something like the Nasdaq, which is the index which tracks all the technology stocks in the US, you're way above the level you were just before the dot-com bust up. And another example could be the 2008 financial crisis. Even if you got in at the top then, and then it crashed, and you're still in now, over the last decade, now your funds have recovered, the investments have recovered.
That's great. What's your favorite company that you've got in that tech fund?
Sure. So I mean, it's made up of index tracking funds. But if I had to choose a favorite company, it would probably be one in the 3D printing space. To me, it's just amazing that if you extrapolate what 3D printing is doing, that maybe one day you literally have like a replicator in your house where you punch in, I want a hamburger, and it builds a hamburger for you. So it would have to be one of the 3D printing index funds. And then if I had to choose one of the stocks, it would be probably Stratasys or one of the other 3D printing. But from my perspective, I don't really look at individual stocks and have essentially favorites, or have ones that are not favorites, because the nature of the beast is that we don't know which is going to be the next Google, which is going to be the next Facebook, which is going to be the next Amazon. So I look at it impartially and unemotionally, and just know that I need to have exposure to the different underlying technology stocks.
Right. Now, without giving away any trade secrets, are there any exciting IPOs or general areas, like you say that you really like, the 3D printing space? I'm quite excited about Lyft's IPO. I'm really interested in that last mile, they call it like the last mile transportation. Like even now in Fort Lauderdale, we've seen a lot of those bird scooters going around. So I feel like this whole new level of transportation, like for me, that's really exciting. What are your thoughts on that?
Yeah, I mean, I think it's very exciting, and that would be one of these technologies and businesses that is changing our future and our current situation. In terms of IPOs at the moment, there's nothing that comes to mind right now from our side. Yeah.
And what are some examples of appreciation growth that you can share with us for people who are looking to commit long term? Like, I'm sure each fund maybe has a different expectation. So maybe if people are looking at the anchor fund, is there a certain percentage you could give us that people could kind of expect or have in mind?
Yes. So the way that we look at wealth management and your financial planning is we do it as an outcomes based exercise. So we say, what do you want to achieve, and then we realistically look at what you can achieve in the underlying investments or the fund that you have, in terms of growth above CPI. So with the anchor, for example, there we would target US CPI plus 2%. And someone who's only has 2 years to invest, that's what they could reasonably expect. We have CPI targeting, so we, as I said earlier on, the silent killer is inflation, and I should explain what CPI is. CPI is Consumer Price Index, and it's basically what inflation is. So if inflation was 2% and you were in the anchor, we would look to target 2%+, which would be 4%. So that's how we, and if inflation went up to 10%, then we would be seeking 12% in returns, 10 plus 2. So then if we move up the risk spectrum, so the more time that you need and the potentially more return, then we would have the cruise fund, which you need to be in for at least 3 years, and that would be US CPI plus 3% targeting. And I must just note that this, it's not, there's no guarantee or anything, and in order to get inflation beating returns, you need to take on the risk, which means the risk of your investments going up and down, short and medium term volatility. Continuing up the risk spectrum, if we went to the voyage fund, which you would need to be in for a minimum of 5 years, then we are targeting a US CPI plus 4% and above. If we then looked at the tech evolution fund, that we would target a minimum of US CPI plus 5. But because of the underlying stocks within that fund, it's very volatile. So, for example, over a period last year, you got 40%, and over a period this year, it's down 20%. But that's the roller coaster ride that you need to be comfortable with and accept if you did choose to go into that fund. What we are finding is some of our investors, they like the sounds of the higher risk tech evolution fund, and together through a consultative process, we end up usually giving them a 10 or 20% allocation, which gives them that equity kicker and gives them the exposure, but is still balanced out by one of the other lower risk and more diversified funds. Because remember, the anchor, the cruise, and the voyage are diversified across asset classes, i.e. they don't only have equities like the tech evolution, or they don't only have stocks like the tech evolution, they have stocks, bonds, cash, and listed property.
Okay. And now a big part of investing too, and this kind of ties in to my next question, is how does it work to invest with Southern Cross, is the fees, because it doesn't help if you're getting all of this, maybe you're getting 2 to 3%, but then the fees are killing you there.
Yeah.
So how does that work with you guys? How are you kind of beating that?
Yeah, so that's a great question, Randy, and that is part of our core investment philosophy, which is manage the things that you can manage. So that would be tax efficiencies, which isn't usually an issue to yachties, and then cost efficiencies, so managing your fees. And if we look at the competition, it's actually predatory what is sometimes being charged. And this is just destroying the wealth journey of a lot of yachties without them even knowing it. So having said that, we have one of the most, if not the most competitive fee structures in the yachty financial universe, and it's quite basic. You would pay a advisory fee, which is 1.25%, and that's for the advice and the consultation process and the ongoing support and advice with managing your investment and going through the wealth process and wealth journey with Mia or one of our other wealth managers. And then you would also have additional fees, which would be there's a $200 per annum policy fee, and then there's also the underlying fees within the funds, which are the cost to manage the fund and the cost to have it on a platform, for example, administration fees, and those will generally be around just under 1.5%. But what investors can do, or interested investors can do, is we are providing a fully transparent fee disclosure, which we haven't seen anywhere else in the industry. So you can literally go onto our website, go to the fees tab, have a look, and it's all broken down. And
Okay.
it's all explained as well. So we want to take away the opacity and the jargon and the fear in investing, and also make it as transparent as possible. The other fee to mention is, and it goes with the general philosophy of the funds, is there is a exit fee if you exit within the first 2 years. And the reason we have that is you shouldn't be in any of these funds for less than 2 years. Obviously, the anchor fund has a minimum time horizon of 2 years. So we're just trying to discourage people from using this as a essentially a bank account or savings account. You need to be committed to a minimum of 2 years. That exit fee, however, is very low relative to the rest of the industry. And the way it works is we take that the 1.25% that we would have earned off of you for the advice over the first year and over the second year, and then we just prorate however many years are left of that first 2 year period. So to use a simple example, if you were in the funds and you withdrew after 1 year, then you would have a withdrawal fee of 1.25% of your assets. And if I compare this to some of the horror stories that I've come across in the industry, for example, is an individual who wanted to invest to put a deposit down for a house for his mother. After a few years, there wasn't a specified exact time period, and he invested about $42,000 over the last 2-3 years, and then wanted to try withdraw his funds, and he was told no, he is locked into a 10-year product, and if he withdraws now, he'll have to pay the fees for the remaining 10 years. So he would only get $3,000 out of his 42,000 invested. So that's just to give you a comparison of what is out there, how predatory some of the practices really are out there. So what we're doing is we're actually challenging our competition to disclose all of their fees right from the top to the bottom, because the other thing we've noticed is when there are disclosures from the competition, they generally don't disclose certain layers, and one of the core underlying layers that they don't disclose is the underlying fees that the underlying managers in the funds charge, and these can be significant. These can add sometimes another 2%, which really destroys your wealth journey and your compound interest curve trying to hurdle inflation. I would encourage people to go onto our website and then have a look. We are fully transparent, and it's all disclosed there. We also, depending on the amount of work that is done, there can also sometimes be an upfront consultation fee, but that is up to 3%, but it's usually negotiated between the wealth manager and the client, depending on the amount of work and the investment itself.
Okay. Well, hopefully your competition too will be putting out their fees so that we can really see, just how amazing that this is. But it's so sad that there's people out there just preying on Yacht Crew because, not everyone has the training that you guys have got. So how are
100%.
you to know? And I think I shared with you already my, story. I was in yachting for a year to save up to go to study fashion in Paris and
Yeah.
put my money into stocks and bonds, and I really shouldn't have. I should have just maybe kept it in the bank.
Yes.
But the people I was talking to were like, yeah, that's no problem. And I ended up losing money on the
Oh
withdrawal.
no.
And it was just, I was working a whole year saving every penny. So that, that really does hurt a lot when people
Yeah.
are working so hard to just save their money. So,
Sure.
and now you guys also offer with the wealth management you help people getting their offshore account set up, right? With
Correct.
Standard Bank.
Yes. We have a partnership with Standard Bank, and we help you set up the Seafarer Offshore account.
No, that's great because, man, if people have any questions, if you guys are legit or what, if a bank's agreed to work with you, that's definitely a solid thing.
100%. We've and it's crazy if people actually get some insight into the amount of vetting and compliance and what we call KYC, know your client documentation that needs to be processed to work with pretty much anyone. Our administrators, International Assurance, Standard Bank, whoever you're working with, the way the developed market financial systems are, is you really can't hide or be dodgy, for lack of a better word.
Right. And so if people are interested about learning more, how can they get in touch with you guys?
So they're welcome to drop us an email or give us a call, and they could fill in a contact form on our website, and I'll just encourage them to go to our website, which is southerncrosswealth.com.
Perfect. And I'll make sure to put everything in the show notes. I'll put you guys' email in there and your website and everything. So if anyone wants to go check out the show notes, you can click through and email them right now.
I'm excited to partner with Southern Cross Wealth to help you get a free Standard Bank offshore banking account. Mention that you heard about them on the Nautic Nomad podcast, and they will get you all set up with their free offshore banking account and investing your money to help beat inflation. That's a wrap. All right, Nomads, thank you so much for tuning in to the first season of the Nautic Nomad Yachting Podcast. I'm really excited about season 2, so make sure to hit that subscribe or follow button so that you know when we launch with the next season. Also, if you're enjoying our podcast, please leave us a review so that we know that we aren't talking to nobody. Also, if you have any feedback about what you want us to explore next, if you have any ideas for who we should interview, you can slide into my DMs on Instagram at Nautic Nomad or shoot me an email, info@nauticnomad.com. Now, don't forget to check out our blog. All the show notes from today's podcast, nice and clickable and easy. Go to nauticnomad.com/blog and you'll see the show notes there from Southern Cross Wealth. You can also follow them on Instagram at Southern Cross Wealth and check out their website, southerncrosswealth.com. Thank you so much for your time. Wishing you so much health, wealth, and prosperity for 2019. I really hope that you check out that planner from the Crew Coach, set some goals, dream big, have visions, and make it happen in 2019. Wishing you safe sails and following seas.